More signs that a recession is coming. Welcome to today's mortgage market update. Today is April 28th, 2022. We have lots of positive and not so positive news to cover today, and lots of charts and graphs to show you. So, we are going to do a screen share today so we can keep you in the loop and hopefully make it much more easier for you to follow along. So, we are going to go ahead and share screen. Okay. So, first off, today we are going to start off with some great news. This week we got Case Schuler's home. I'm sorry, I cannot talk today. Case Schuler's Home Price Index report. Now, this is the gold standard for appreciation. This shows that prices rose 1.7% in the month of February. Now, this is up 19.8% year over year, which was an increase from 19.2% from the previous report. Now, again, the top three performing cities, I know this sounds like me just repeating myself over and over, but it was Phoenix up 33%, Tampa up 33%, and Miami up 30% as well. Another appreciation report we received was FHFA's Housing Price Index. That's the Federal Housing Finance Agency's House Price Index, also for February 2022. And this measures home appreciation on single family houses on conforming loan limits. Now, there are some houses that do fall under conforming loan limits that are $1 million houses in different areas of the country. But for most of us, a conforming loan limit means a home that is under, or a loan amount that is under $647,200. So in our area, that is the majority of us, but not everybody. And it's showing that home values rose 2.1% last month, or I'm sorry, in the month of February, and it's up 19.4% year over year. And this is an increase of 18.3% from the previous report. Now, it is important to note that yes, appreciation is up, but it's also important to remember these numbers are for February, and this doesn't factor in the biggest interest rate increases that we saw in 2022. While yes, we did have interest rate increases in February, the biggest increases came in March and in April. So we won't see that until we get the later reports for Case Schuler and FHFA's reports until later months ahead. But I do still expect to see appreciation to still be there, flat at the least, given the contracts that are still coming across our desk right now. The next thing that we did get this week was pending home sales. Now, this measures signed contracts, and this was for February of 2022. Now, this makes up about 90% of the housing market, and it actually fell 1.2% in March. Now, this was stronger than it was expected. We were expecting a 1.8% decline, so a little bit better. It is showing sales are down 8.2% year over year. Now, there is no doubt that higher interest rates are impacting demand a little bit because it is affecting the buying power of the buyer. They can, when you increase interest rates to have that same housing payment per month, they have to spend less on a home. But it's still a very strong market, very strong housing market, considering the increase in prices and the lack of inventory. So I'm going to stop sharing for a second, bring you back to me. It is important, though. We do want to just let you know there's a couple other key things that came out. Redfin came out saying that their amount of their bids that they are seeing is pushing prices higher, meaning multiple bids on homes, people bidding over ask, is starting to slow down. Well, yeah, of course it is. But the key is more than 50% of their offers are still bidding over ask. So it's still a really, really strong housing market. So, well, Redfin, yeah, I see what you're saying, but I mean, it's still really strong. And it's also important to note that CoreLogic released their single family rent index this week, showing that rents in February were up 13.1% year over year. This is the highest increase on the report. And again, if you saw my video, the biggest way to curb against inflation is to stop renting and own a house. Because remember, as inflation keeps going up, your rent's going to keep going up. And you can see that in this report. You're not going to see that if you own a home and you lock into a fixed rate. Now, this week, we also got our first look at first quarter GDP. And this showed growth was actually down 1.4%, which was much lower than the 1% increase that we were expecting. Now, this is coming off of a 6.9% increase in quarter four from 2021, which was mostly due to inventory that was built. This decline in GDP for quarter one is another sign of a potential recession. And let me show you why that is. And remember, if you watch my videos, you know that recessions are a general rule of thumb is recessions are the past 2 quarters of negative GDP. But you don't know that till after you go through it and you're looking in the rearview mirror. So this is to show you, because a lot of people are asking, well, is the federal funds rate, are they going to stop raising the Fed rate because GDP is now negative? And the answer is no, because you need the federal funds rate to increase to lower that inflation. If we don't raise the Fed funds rate, you're not going to lower the inflation. But here's where you can see as they raise the federal funds rate, that's the blue line, and the gray line here is your recessions. So as they raise the federal fund rate, recession. Raise the federal fund rate, recession. Here's a big increase, recession. If you were alive in the 70s and 80s, you probably remember the big increase in inflation. They took the federal funds rate way up, inflation. They dropped it back down way too soon. Had to take it back up, and you see this great big, whoops, I went too far, inflation that went back. And then you can see this go down. Here's the tech bubble that happened. And you can see how every time they had to raise the federal funds rate, you had a recession. And here we are down here. And the Fed is expected to raise the federal funds rate to 2.5%, 3%. Some even say as high as 3.5%. And yes, this is going to slow down the economy, but we're behind the 8 ball. And in our opinion, we are headed for this recession. And you can see by the ups and downs of our economy here with the federal funds rate in a recession. This is why we believe that the Fed is, kind of to blame for our boom and bust cycles in our economy based off of how they do the highs and lows with they're just, if they would have raised the Fed funds rate last year, they would have kept us out of having such high inflation, which probably would have kept us out of having the inflation or the recession that's coming. Now, initial jobless claims came out for the week of 4/23, showing individual filings unemployment for the first time decreased by 5,000 people to 180,000 people. Now, continuing claims, the people remaining on unemployment, this remained relatively unchanged. So while claims are relatively low, the unemployment rate is at 3.6%. Now, remember, recessions happen when unemployment rate is at its lowest. And since we believe a recession is coming, claims may start to tick back up before the recession actually triggers and happens. So let's take a look at that chart. And you can see here, unemployment's at its low, and you see the unemployment go way up. Unemployment's at its low, and it goes way up. And you can see that the whole way through the chart, because the lines are the unemployment and the dark vertical lines here are the recessions. And that is because, when the Fed raises its Fed funds rate, it slows the economy down. People stop eating out. People stop going to stores. They stop going to movies. They stop spending money. The stores, the restaurants, et cetera, they start laying off people. Unemployment rate will tick up and the recession happens. So we are at 3.6% right now. And right before COVID hit, we were at 3.5. So basically we're at about not the all-time lows, but pretty close to it. So that's just another sign that the recessions are coming. So just some other quick information here. The MBA released mortgage applications for last week. Purchase applications decreased another 7.6% last week. Purchases are down 16.6% year over year. But don't forget, you got to factor in cash buyers. And when you factor in cash buyers, purchases are actually down 13% year over year. Speaking of rates that we did earlier, MBA reported a 30-year fixed rate is at 5.37%. This is practically a 13-year high in rates, and it's up 2.2% from this time last year. And remember, those rates are considered an average between purchases and refis. And as expected, refis fell another 9% due to the interest rates. They're down 71% year over year, but refinances are still making up 35% of all transactions. And that is because of people doing debt consolidation loans and also delayed financing. So they may be paying cash to buy the house and then they're coming to us even before they settle and we're starting their loans for they want to have a loan on the property. So we're starting the mortgages on the property so they can have it. And then we always like to show you a quick chart of where mortgage-backed securities are trading. Look at this. We actually, fingers crossed, we've hit this little steady pattern right here. This is a floor support. Now, it is a very old floor support, but you can see we've broken through all these other ones. But we are remaining steady, and we're hoping we can just kind of hang on right now because, as you can see, the past 2 months have just been a big downturn. But we're hoping we can remain steady, and we'd like to even just continue and push through these ceilings up here, but we will see what happens. But any questions, please don't hesitate to reach out to the Rebecca Foote Mortgage Team. We are here to help you. 717-609-4044 or check us out at RebeccaFoote.com. Have a great rest of your day.